Hi, I'm Ross from Coon Smith 150 Group Property Accountants, and today just going to look at a simple example, just a simple property. Yeah, what do the numbers look like? And yeah, what do we think about it? So this property is in Tokoroa. It's just the first one I could find that had a value and had the rent. So yeah, it's property for sale at the moment. Obviously, I'm not selling it. I'm not suggesting you buy it or anything like that. It's just an example property that we can run through. So it's this property in Tokoroa. Yeah, it's for 420,000. It's a four-bedroom property. It's got some information, and yeah, it's rented for 380 a week. So let's have a look at those basic numbers with it. So anytime I look at a property, I look through the basic numbers, and it's all about how you interpret those numbers, and yeah, looking at what sort of things go in there. So if we look at our Tokoroa example, so yeah, 420,000. We're looking at 380 a week. And Tokoroa to me, just a little bit rougher, a little bit harder to rent. The property doesn't look the best. So I'm looking at probably realistically, I'm not expecting 52 weeks, and I've gone 50 weeks. So first stats, 50 weeks times 380, 19,000. 19,000 divided by 420 is a 4.52% gross yield. So if you're in Auckland or somewhere like that, you're actually going, hey, 4.52% is not actually too bad. This is sounding pretty good. And if you'd worked on 52 weeks, you'd be going, oh, close to 5%. This isn't too bad. But the thing is, that is just the gross yield. So it's just an initial indication. Yeah, does it give you all the numbers or all the details? So then obviously we've got the bank fees. So generally there is some sort of bank fees, not a body corporate insurance. Quite often I do a quick comparison. So if we jump on Initio's website, again, I don't get kickbacks or anything like that. I've got no idea when it's built. I'm sure I can search in there for when it is. Town water supply. It's going to be used by tenants. How big is it? So I've made these figures up, but you could obviously look through the details a bit more and actually get these and get a quote. So why I love this is it's so quick, it's so easy. You can get some basic information. You can look at what you need to do for the sum of the property and check that's reasonable. Yeah, you can look at the how much loss of rent cover you want, contents and different things, and it gives you an idea of the premium. So obviously, if you were going ahead with this property, you would put in a bit more detail and look a bit higher. But yeah, insurance maybe 1,200. Interest rates have obviously jumped up to 2.5%. Property management, you might find it's a little bit higher. So I've got a standard in here at 8. You might find it's 9 or 10% or something like that. So you've got some property management rates. Then we're looking at repairs. So if we go back to the property, what does it look like? To me, yeah, you're looking like you've got a reasonable amount of work that you need to do on that property, and quite a few things. It's just little things you're going to have to look at. Yeah, just lots of things. There's quite a few trees, quite a few things that you might have to look at long term. So I'm looking long term, do you have to paint it? And you might not for a while, but at some point you will. Um, yeah, so to me, you've got quite a lot of work, quite a few things that you're looking at doing on this property. So I'm looking probably at least 3,000 a year for repairs. So over the next year, spending 30,000, and you might do an initial renovation on top of that as well. I then allow for some education. You might join something like Waikato Property Investors, some travel unless you live in the area. So if you bought this property today, 420,000, 19,000 income, 23,000 expenses, losing $4,000, you're probably not going to get great chattels depreciation, but there's likely to be some in there. And obviously, I'd have a better look through how good is carpets, curtains, dishwasher, stove, heat pumps. And if they're good value, then looking at getting value it in to do a chattels valuation. So old rules, you're looking at losing a whole lot of money, paying no tax. New rules, obviously, if you're buying this now, you're going to lose that interest deduction from the 1st of October. So, yeah, your taxable profit goes from 5,000 loss to 5,000 positive. You're then looking at paying some tax. So, you're losing some money, paying some tax. I then look at what's going to happen with this property over the next 10 years. And no one knows. We don't have a crystal ball. No one's got a clue really what is going to happen. But based on history, property went up about 6.3% a year. So if we did the same thing, this property should go up. If we stay on interest only, and all these numbers are interest only, the rent should slowly go up over time. All the expenses up over time. Interest maybe 2.5 up to 5%. Look at the loss all the way along. It is terrible. Um, and that's before the new tax changes. So before these tax changes, should you have purchased this? Well, it depends what else there is. If there's a big subdivision opportunity or some other added value, maybe. But just how the numbers are, no, it is hideous. Then you're going to lose your interest deduction. So the profit is going to jump up. You're going to pay some more tax. So you're looking at losing lots of money every year, but paying a whole lot of tax. Overall, for this property, over a 10-year period, you're looking at losing 100,000. So that's 10,000 a year you're looking at losing, and you're hoping or gambling for it to go up 300,000. Yeah, so to me, this cash flow is looking terrible. I do a little summary of the sort of different options. So old rules, if say it was a new build, which is obviously not, you'd be losing 8,000 a year on average, 79,000 over 10 years. Existing rental interest phased out over 4 years, close to 10,000 loss or 100,000. And yeah, losing the interest from 1st of October 21, which would be what happened if you purchase this property now, you're looking at losing 10,000 a year. So to me, yeah, this is a really terrible cash flow property. There'd have to be an amazing added value opportunity for me to look at this. And yeah, it sort of shows you that that gross yield, it's only one factor. Don't buy a property based on gross yield. You need to go through all the cash flow, go through all the numbers. And it's not about having a fancy spreadsheet. It's about actually going through and understanding what this actually means. So for these, yeah, if you're looking at buying these properties, have a sit down meeting with me or a Zoom meeting with me. Go through this for an hour, how this is going to work for you. And yeah, maybe how it would compare to something else. And the key thing to me, it's like always, it's buying a property that makes sense. We don't know what's going to happen in the next little while. The market might go up or down or sideways, or yeah, we just don't know. Everyone is guessing. So it's important to buy a good property that's got the good fundamentals. Generally, you want some sort of equity increase and you want some good cash flow. This, from a glance, doesn't seem to have that equity increase, and I haven't really focused on that, but it's got terrible cash flow. And you realistically want both of those. So to me, yeah, it's about buying a good property where you can add value. You've got some good opportunities, and not buying something like this that's just going to drag you down. You're really just gambling on capital gains. And maybe 10 years' time, you'll be laughing at me. Oh, that guy told me how terrible it was. But realistically, you can do so much better, and that's the thing. Property investment's not about gambling, it's about investing. So you need to, yeah, work through it. And if you've got better cash flow, so much easier if something goes wrong with your life, so much easier to move ahead, and that's really key. So hopefully you've enjoyed that. Thanks a lot. Bye.